All right, welcome back to July Federal Reserve Minutes, shedding a little bit of light into the committee's conversations about where interest rates might go. Two members calling for cuts, and now the focus, of course, shifting to Federal Reserve Chairman Jerome Powell's speech in Jackson Hole, Wyoming. Rick Santelli joining us now. Rick, you put out a note to us internally about this. On one hand, they're talking about inflation, and on the other hand, they're talking about weaker jobs. That's a tough combo.
It is. It's a tough combo, but I really do think that the market has an opinion here. If you look at how all the market's interest rates lined up after the big negative jobs report we had a couple of weeks ago, you will see that markets haven't recovered fully because the onus of a Fed ease, or at least the onus of what's going on in the economy from the perspective of the markets and the yield curve and all the information we can glean in the Treasury complex, certainly seems to lean that the weakness in the labor market got bigger moves than some of the inflation numbers like CPI and PPI. It's really quite clear. Now, I'm not saying the Fed's right or wrong, but I'm saying the markets have an opinion. And when you move beyond that and look what happened today you see the intraday charts. Now it's washed out a bit, and you have to make a lot out of a little because the ranges have been small. But we did see 2 years lead the move. You see that blue line kind of shifted briefly, but everything's kind of caught up. The curve flattened initially. 2-year note yields rose almost to unchanged, while the 10-year didn't move much. But we're only splitting basis points here. For all practical purposes, hovering around 430 in a 10 and hovering around 375 in a 2-year, we're really going nowhere fast. Maybe the most important thing I see today is called the knob spread. It's 30s minus 10s. Nobody's probably going to trade it there. It's not something that a lot of outsider retail trade, but insiders love to monitor it for one reason. The wider it gets, and it's the widest it's been in 4 years, the wider it gets, that usually sets up the notion that longer duration Treasury yields will be stubbornly high compared to the rest of the curve. So that's why we watch it. And I continue to believe that I'd like to see the Fed ease a quarter point, Brian, because I'd love to see what the yield curve does. My guess, if they cut 25, the yield curve steepens 12 basis points.